The car market is currently undergoing a crash, which will have severe repercussions for buyers, sellers, and dealers. In 2023, the U.S. auto market found itself in a massive bubble, with record-breaking prices for new cars and used cars experiencing a staggering 42% increase compared to 2019. However, a combination of factors is now causing the value of cars to plummet. Concurrently, auto loan debts are skyrocketing, and even individuals with good credit scores are struggling to afford car payments, leading to vehicle repossessions. An influential industry executive warned that this situation could potentially trigger the next financial crisis. And given the rapid pace of this downturn, his prediction seems accurate. To illustrate the gravity of the situation, we have compiled a video highlighting multiple facts that substantiate the dire state of the U.S. auto market. Before you proceed to watch the video, we kindly ask for your support by liking and subscribing to our channel. Without further delay, here are 15 indications that a substantial car market crash has already begun. 1. New car prices have reached unprecedented levels, with the average price in the United States surging to $50,000 in February 2023, from $38,948 in December 2019. This record-breaking increase, according to data, represents the highest price ever recorded for a new car. Many consumers are stretching their budgets to afford a new vehicle, with the average monthly payment rising by 26% since 2019 to $718. Additional expenses associated with car ownership, such as insurance, fuel, and repairs, have also seen significant increases. This surge in prices poses challenges for the majority of Americans, as warned by Ivan Drury, the Director of Insights at Edmunds. All car models have experienced unsustainable price surges in recent years. 2. At the beginning of the pandemic, automakers expected a decline in car demand and reduced production accordingly. This, coupled with a shortage of new cars caused by microchip manufacturers, led consumers to turn to used cars, taking advantage of stimulus checks and low interest rates. The result was a rapid and unsustainable increase in used car prices, which grew 4 times faster than the availability of new cars. However, the time has come for a reckoning. 3. Increasing numbers of Americans are falling behind on their car payments, signaling a concerning trend. The strain of soaring car prices and persistent inflation has pushed more households to struggle with car loan obligations. Among the lowest income consumers, the rate of loan defaults now exceeds pre-pandemic levels. Data from the rating agency Fetch reveals a 6.2% increase in loan defaults in January, marking a 33.5% rise compared to the previous year. This troubling situation is expected to persist as households face financial difficulties. 4. Car repossessions are increasing, even among prime borrowers. Barron's data shows a significant surge in vehicle repossessions, doubling the rates for prime borrowers and increasing by 11% for subprime borrowers. This indicates that both creditworthy and lower credit borrowers are facing challenges. Repossessions occur when borrowers become delinquent on car payments, leading lenders to seize the vehicles. The rise in repossessions highlights the broader financial impact beyond losing the vehicle, as mentioned by certified financial planner Angela Dorsey. 5. The rapid increase in repossessions is overwhelming the repo men. Jeremy Cross, president of International Recovery Systems, shares the overwhelming demand for repossessions, leading to challenges in finding enough repo men and adequate storage space for the repossessed vehicles. The situation is described as a perfect storm, with growing volumes and limited repossession services availability. Cross warns that the trend is likely to persist, potentially reaching levels seen during the Great Financial Crisis. 6. Auto loan debt has reached a new record high. As of 2023, auto loan debt ranks as the third largest debt category, trailing behind mortgages and student loans. The Federal Reserve Bank of New York reports that Americans owe a staggering $1.52 trillion in automotive loan debt, accounting for 9.2% of overall American consumer debt. 7. Presently, car buyers are taking longer to repay their auto loans than ever before. Experian researchers discovered that in 2019, the average auto loan term for new cars was 44.5 months, while leased vehicles had an average term of 24.2 months. However, the average auto loan term has now reached alarming figures: 69.7 months for new cars, 68.1 months for used cars, and 35.9 months for leased vehicles. Additionally, over the past year, there has been a 25% increase in auto loan terms ranging from 72 to 84 months. 8. The outlook worsens due to rising interest rates. The Federal Reserve's tightening of credit is exacerbating car affordability issues. In 2021, the average interest rate for new car loans was 4.1%, and for used cars, it was 7.4%. However, borrowers now face a 6.5% interest rate for new cars and a staggering 10% for used cars. Unsurprisingly, experts suggest that the increase in interest rates could result in a $22 billion decline in automotive sales. Ivan Drury explains that interest rate hikes are significantly impacting buying behaviors, making borrowing money more expensive and reducing demand for used cars. Consequently, Edmunds data indicates that this year, consumers may purchase 150,000 fewer new cars and 500,000 fewer used cars. 9. The car market experienced its worst sales in a decade in 2022. Research firm Ward's Intelligence reported that only 13.7 million vehicles were sold last year, marking an 8% decline from 2021 and the lowest sales figure since 2011. Stellantis, the parent company of Chrysler, Dodge, and Jeep, witnessed a 13% drop in U.S. sales in 2022. Honda recorded a 33% decrease, while Nissan reported a 25% decline. Even Toyota, the world's largest automaker, saw U.S. sales dip by approximately 10%. 10. Tesla is experiencing a significant price collapse. CEO Elon Musk has expressed concerns about the economy and the potential for a deep recession, which could negatively impact the auto industry. In response, Tesla has announced workforce reductions of around 10%. However, the company is also addressing pricing issues. Over the past years, Tesla had been raising the prices of its new cars. For example, the Model Y reached a peak price of $77,000, but subsequently faced a $13,000 decline in value by January, disappointing many owners. The same model is now being sold for $52,990, a substantial $25,000 drop from its peak. Consequently, buyers of the Tesla Model Y may find themselves in a situation of negative equity on their loans. 11. Carvana, often referred to as the Amazon of used cars, is facing significant challenges. The company's shares have plummeted more than 36% to $4.27 amid concerns about meeting payment deadlines. Since December, the stock has experienced a staggering 45% loss, with a brutal 43% drop in November alone. Since January 2022, the stock has tumbled by 98%, after ending 2021 at $231.79. The critical question now is whether Carvana can navigate this extremely challenging period. Bank of America Securities has expressed concerns that without a cash infusion, the company may deplete its cash reserves by the end of 2023. While the scenario of bankruptcy due to tighter credit conditions is deemed unlikely, the situation remains precarious. 12. Conversely, chip manufacturers are finally catching up with the demand. Goldman Sachs reports that chip manufacturers are increasing their production levels to meet global demand. This development implies that auto production is expected to normalize by mid-2023 as automakers secure the necessary chips to restore a regular supply of new cars. As new car inventory stabilizes, the demand for used cars is predicted to decrease. J.D. Power forecasts double-digit price declines for new and used vehicles by the end of this year. 13. Experts are confident that the used car bubble has already burst. A recent white paper by Durka Carlisle suggests that the used car bubble has burst, with new cars becoming more readily available as supply chain challenges start to ease. Mannheim research indicates that used car prices have declined by nearly 15% year over year. Additionally, a shortage of spare parts has driven up repair costs, with prices for wheels doubling and ornamental parts sometimes missing. The increasing labor costs are also a consideration for high-mileage used car buyers. Craig Moore, an experienced industry professional, concurs that the used car bubble has burst as finance companies refuse certain loans and insurance companies decline coverage due to the projected lower value of these vehicles compared to their asking prices. 14. A study suggests that the used car market's recovery may not occur until after 2025. Jerry, a car insurance comparison site, conducted a study revealing that the used car market may not recover in the foreseeable future. Despite the increase in new car inventory, fewer used vehicles are entering the market. The study highlights the decline in leased vehicles, a significant source of used cars, with only 400,000 entering the market in 2022 compared to 2.4 million in 2020. The researchers explain that many leaseholders are holding onto their vehicles due to favorable deals resulting from high used car prices. They estimate that it will take up to 3 years after the new vehicle market stabilizes for the used car market to rebound, with several uncertainties influencing the timeline. 15. A nationwide car market crash is anticipated as demand declines and inventory increases, leading to price adjustments. A report from J.P. Morgan predicts a potential decrease of up to 15% in prices for new vehicles and 45 to 60% for used vehicles. Such a scenario would cause distress for millions of borrowers and significant financial losses for dealers and lenders. The outlook appears grim, and the numbers indicate an impending car market meltdown. The consequences of a car market collapse extend beyond the automotive industry, potentially triggering an economic downturn with widespread job losses, bankruptcies, and reduced consumer spending. The ripple effect could disrupt supply chains across various sectors, as car manufacturers rely on extensive networks of suppliers. Musk's warning about a potential financial nightmare holds weight, demanding close attention to the developments of this crisis, as it will have a profound impact on society as a whole.